Hi there. So this is a video to present my learnings about the topic of the process of IPO, which is an initial public offering for a company, right? Now, if you don't know me, my name is Moran. I'm the founder and CEO of acquisitions.com, and we were involved in transactions of almost $1 billion since funded at this point. And this video is to share with you anything and everything that I've learned about this topic to hopefully help you save some time to learn the topic if you're a company, founder, or an investor. Now, please understand that this is not here to be a financial advice, investment advice, legal advice, or any advice at all. And I'm not here to claim I know anything about IPO. I want you to see it as just a passion project of mine to fully clarify and understand the IPO process, and just me sharing my level of personal understanding of everything IPO at the moment. Now, obviously, I didn't invent IPOs, and everything in this video is me using all the knowledge that is out there, that is available to the public to see. And I'm mostly following the words and work from many different mentors that I worked with and did deals with, and information, of course, that is out there for everyone for free. So hopefully you enjoy it and learn from it as much as I enjoyed and learned a lot while creating it and doing it. Now, a lot of the things that I'll talk about are very technical, but they're important in understanding the process and everything involved in it. So I hope you'll find it important and interesting as much as I do. So with that being said, let's get started. Starting with, what is an IPO? So let's talk about starting with understanding how a young company, or even an old one, established one, can offer its shares to the public for the first time. This is done through an IPO, or initial public offering, which is basically like the idea of opening the doors for people to become part owners of the company. You see, when a company needs a new source of financing, it can list its shares on a stock exchange to raise investment capital, and that's the idea of an IPO, right? So first, the process is that shares are sold to an institutional investor who then offer them to the public through a secured exchange. So in simple words, an IPO is just another way for companies to go out there, raise money, and it's commonly referred to also as flotation, or going public. So if you heard those terms, pretty much the same. So imagine, let's say you're a founder of a company looking to raise capital. First of all, would you consider going public through an IPO, right? And we're going to explore why it's good or not. So as we mentioned earlier, a company going public through an IPO can access more capital than before, right? Since it's opening up for a larger pool of potential investors, which means that it can be a game changer for businesses that need more funds to grow and succeed. But also remember that an IPO isn't all sunshine and rainbows, right? It can also bring about significant changes in how the company is managed, presenting both opportunities and challenges for the business, the investors, and everyone involved. Now, I'm curious to know, if you're watching this right now, first of all, are you a CEO of a company? And if you were a CEO of a company, would you prefer to stay as a private company or go public through an IPO based on the information you have right now? And let's get through that. Like, why go through the IPO process in the first place to get listed? And let's explore a few different things, right? So first of all, why a company might decide to go through the IPO process despite it being time-consuming and expensive. And let me share with you some of those reasons, right? Starting with the idea that, first of all, raising capital. Companies, when they go public to raise funds for projects like business acquisitions, expansion efforts, or paying off debt, right? Another reason companies go public is providing an exit for investors, right? So current investors may want to sell their shares in the future, and an IPO allows them to do so. Also, the idea of gaining acquisition currency. So it's easier for public companies to make acquisitions since their stocks have a clear value and can be used as purchasing power, right? So rewarding and attracting employees can be another reason to go public, because early employees who took, let's say, lower pay for equity in the business may want to cash out. Plus, as a public company, it can attract top talent when its reputation and stock-based compensation packages, right? Think about some of the biggest companies you know. It's pretty exciting to work there. Also marketing the company, because an IPO can boost the company's reputation and bring new investors, customers, and business partners. Also potential higher valuation. So public companies can be worth much more because of the transparency, strict operational rules, and investor accessibility. And I mean, it's exciting. Going public is like playing in the top league, you know, and it can be a super exhilarating experience for experienced and ambitious entrepreneurs especially. So which of those reasons do you think is the most compelling for a company to go public? Like, there's a lot of people who think differently, but I think those are really good reasons to start with. So let's dive into how companies, first of all, get their valuation when they do an IPO. Because IPO valuation depends on factors like demand for the company's shares, market conditions, growth potential, and the company's background. And remember, strong demand doesn't necessarily mean a better business, but it can lead to a higher valuation overall, right? Market conditions and timing play a critical role as well, right? Because two similar businesses might end up with different valuations because of these factors. Industry comparables are also helpful for finding the right IPO valuation. If similar publicly listed companies exist, comparing their valuation parameters can help with the process, right? You just go out there and find similar businesses and see what's their value. Future growth forecasts are essential as well, since the main goal of an IPO is to raise capital to fuel growth. So a successful IPO relies on the company growth potential and whether investors believe it will succeed or not. And lastly, the company's story can be just as important as its growth forecast when it comes to understanding the overall and figuring out the value. So a lot of those different factors determine the valuation of an IPO. What do you think is the most important one here? Because here's a cool anecdote. Like, think back in the 90s when internet was taking off. Companies that were pushing innovative ideas and revolutionizing the world achieved back then multi-billion-dollar valuations without generating revenue at the time at all, right? And they managed to create an impression of being a company with experienced management and high likelihood of success. But it took time for the market to learn which ones were actually worth something, right? Like the Amazons versus the pets.com that doesn't really exist anymore. So keep in mind that many factors determine the IPO valuation, such as similar stock in the market, growth potential, and the company's background. Sometimes a company's actual results can be distorted by its marketing strategy. That's why early investors should study the business financials and be cautious about investing in a company without a proven trading history. And that's one of the biggest lessons I think everyone learned in the dot-com bubble. Many argue that the purpose of the public equity market has changed since 20 years ago, because previously IPOs were mainly used to fund things like capital expenditure, right? And investors saw them as a way to generate higher returns. Today, getting listed and becoming a public company is more about liquidity for the business, right? So it helps motivate employees who are offered shares and gives founders a way to exit or sell some of their shares at a premium. That's how you see, employees in the tech world making millions because they can sell their shares. Now, before we dive into the details, let's familiarize ourselves with some essential but slightly boring aspect of IPOs. Starting with the first one, which is disclosure, right? So let's talk about the IPOs, an important role of the Securities and Exchange Commission, SEC. Maybe you heard about them. So the SEC is kind of like the watchdog for companies in the US that want to go public, like when they want to go through an IPO, right? Their main job is to make sure these companies share the right information with everyone, the stuff that might affect whether you'd want to invest or not. And also, guess what? Like, once a company goes public, they've got to keep sharing this kind of info all the time with the public. So it's all about being fair to the investors, like you and me, so we know what's going on with the business, right? With the company's money and the business operations and whatnot. But also, they don't have to tell us every little thing. They just need to tell us the important stuff that could change how the company is doing financially. So this helps keep the market fair and honest, right? And it helps prevent sneaky stuff like the Madoff Ponzi scheme and Enron. That still happens, but it helps preventing those. Now, you might be wondering what companies usually need to report. Well, they've got to share things like any current lawsuit that they're facing, audited financials, those are like the report cards pretty much, info about the company's goodwill, how they do their accounting and any changes to it, details on all their assets and liabilities. Also, if they've lost anything important, right? So, and any predictions that could change their financial results, they need to share all those things. So that's the SEC role in a nutshell, right? They need to make sure they're making sure that companies play fair when they go public. So we all the retail investors have the same chances to make informed decisions of if and when we want to invest in them. Now, where do we retail people find the information, right? So let's dive deeper into how do we go out there and find all the information about public companies, because they present it to the public for a reason. But let's let's talk about where do we find each of those things. So if you ever wondered, it's all in, first of all, the regulatory reports called SEC filings. These are like kind of like the company's diary where they share all their secrets with us. The most important ones to check are the annual and quarterly report. They basically got all the juicy stuff like audited financials and the leaders' opinions on how the business is doing. So it's like getting a backstage pass to a company's life, which is pretty fascinating if you enjoy learning about the company. You'll also find info about the risks that they face and their plans for the future. Plus, you can also usually listen in on conference calls with the big bosses of the business to hear their thoughts about their report. It's pretty cool. Like you can listen to all those, inner dealings. Now, the SEC filings can be very brutal for some entrepreneurs, but it's super important to keep everything fair with everyone else. Moving me to the next topic about S1. So we've been talking about the SEC filings. Now let's focus on one of the most important ones, which is Form S1. Maybe you heard about it, maybe not. But Form S1 is like the golden ticket for companies in the US that want to go out there and go public. What they need to do is they need to fill the S1 before they can start selling their stocks on big exchanges like the New York Stock Exchange or Nasdaq, if you heard about it. So think about it as their IPO passport or whatever you want to view it as, where they share all the nitty-gritty details about their business, like what they plan to do with the money they raise, how they stack up against their competitors, and even a full brochure about the company. So it's like a super VIP pass to their, kind of like to their inner workings of the business. And guess what? You can even find out about their pricing criteria and any deals that they have going on with board members and outside advisors, and see kind of like how much money each making and how much shares each got. So maybe you looked at an S1 before, maybe you didn't, but it's super fascinating if you want to learn about a company. Now, in regards to how a company filed the S1, let me introduce you to a super helpful tool called Edgar. I don't know if you heard about it or not, but Edgar is like a giant library for all the SEC filings, including our friends, the Form S1. So to use it, you just need to fill out the Form ID, get your login details, and then you're good to go. Now, they have all the guides to help you find out what you're looking for if needed. So let's dive a bit more into the Form S1. So they got two main parts in that form. So part one is known also as prospectus. It's like a roadmap to the company's inner workings, and it's got stuff like understanding what the company does, how much money they're raising, and how they'll use it, the price per share, a summary of the management team, so you could really understand who's in control, who's doing what. It's pretty cool. The company's financial situation, and even details about who owns what in the company and who's kind of like underwriting the whole deal. Part two in that form, it's not really required or a must reading, but it's got bonus info like recent share sales and when the company plans to release financial reports, just details like that. Now there's also this less known form called F1. This one's for international companies that want to join the party, kind of like in the US market, which everyone wants. It's got extra details that US investors might need to know, like taxes and legal stuff in the company's home country. Next, let's talk about requirements. Going public is like a huge milestone for many businesses. It's not just about selling stocks. It's like telling the world, hey, we've made it and we're solid business. Right? Think about all the companies that you know about. Most of them are public, the big ones. That's why so many entrepreneurs dream of launching an IPO. It's like getting the stock market, kind of like call it seal of approval, and really an opportunity to unlock new doors for growth of the business. But also let me tell you that going public, obviously it's not just a walk in the park, right? There's a whole process to go through, and it can be super challenging and costly. One of the first things you'll need to do is, in order to go public, is put together a top-notch team, right? So that's kind of like one of the first steps. Like you need to think about how can you choose the right auditors, law firms, investment banks to act as underwriters. So the success of your IPO could really depend on the quality of this team. Like pretty much any business, like the quality of the people around you will determine the quality of the business. Same with an IPO, right? So with that being said, next let's talk about getting a company ready for its kind of like a big debut as a public company. Because after you build the right team, it's all about gathering the right data and submitting a registration statement to the SEC. This process covers every aspect of the business when you go through it, from marketing and finances to taxes and legal stuff. And once it's all done, the shareholders can finally sell their stocks to the public. Now, what does being public in general even means? Being public or being a public company involves several activities, right? So it means that Things like updating and maintaining financial reporting processes, like very specific way of doing it, building strong investor relations, meeting the SEC and chosen exchanges requirements for regulations, different disclosures, corporate governance, and listing, right? So you need to be aware of those things, which we'll dive into as well. Next, I also want to dive into some of the steps to help you assess if your business is even ready to do an IPO. Starting with accounting and financial reporting, right? So you want to go public? First, you'll need audited financial reports to tackle any disclosure or accounting issues. Audited financial statements are those checked by certified public accountant. And what they do is that it's basically an opportunity to ensure that they follow general accounting principles and auditing standards. Before going public, it's crucial for a business to have its financial and interim reports audited. And it's simpler and more cost-effective to perform regular audits instead of waiting until just before going public, which too many companies do if they didn't prepare for it in advance. Also, you need to make sure that the right financial team is in place to meet all those demands of new public stakeholders, right? They'll need to ensure data accuracy, strict budget monitoring, forecast, quick filings of reports. So having skilled public company professionals is a top priority for a company planning an IPO. Next, let's talk about internal controls. Now, apart from having a strong financial foundation, it's crucial for companies to assess their internal controls before they decide to go public. Company leaders, management, they should start examining those controls early on, giving them enough time to implement and evaluate their effectiveness and make sure nothing is shady, right? And let's talk a bit about some of those key provisions found in, let's say, different stock exchanges, right? Because most board members in a public company should be independent to start with, right? So it means coming from outside the organization. Public company boards must have an independent audit committee as well, right? With at least one member certified as a financial expert. The company's external auditor is restricted from providing non-audit services like valuation, legal, or internal audit services, ensuring they remain neutral and focused. Lastly, it's important for the company to establish an ethics code for all their senior financial officers. So by addressing these provisions, companies can then ensure that they're ready to meet the demand of being publicly traded, which is a big responsibility. Which moves me to the next thing. Let's talk about taxes. Going public isn't only about selling shares, it's also about making sure your company's the tax structure needs to be efficient. And remember, this video in general is not legal advice, tax advice, or anything like that. It's just sharing what I've learned from the process, right? And understanding that when the company goes public, previous owners usually sell their shares, right? The owners of the business, which can lead to taxes on profits, dividends, and IPO proceeds. But there's a way to work around it with what we call APCO or PubCo structure. And some structures like REITs for real estate are also when it comes to certain sectors. The PubCo structure has some pretty cool advantages, things like keeping the tax benefits of what we call a flow-through investment that allow to enjoy greater proceeds when there's an exit event. But also, we can't forget that you also need to plan for compliance with local and state and tax laws and all that, right? And this can impact both your business and shareholders. So overall, a good planning is needed before going public with taxes. You might find ways to save on taxes for your company and individual stakeholders and shareholders if you plan those things in advance. Next, let's talk about compensation and HR, human resource, when it comes to a public company. So there's another, I think, really exciting part of getting ready for an IPO, which is, first of all, companies need and must evaluate their executive compensation programs. You see, SEC filings, they require businesses to disclose all details about the benefits packages for their directors and executives as well. Now, why does that matter? Well, it helps shareholders, first of all, understand the management abilities, the company governance, the value creation strategy, and also all the risks involved. These packages are designed to attract, motivate, and retain top talent. Now, it's super essential for a company's compensation plan to align with, obviously, the business strategy. And guess what? Creating a long-term benefit package is crucial for keeping everyone, like the management and employees, everyone motivated to grow the business. And that's why many companies, sometimes right after their formation, develop those programs for their employees, benefits and things like that, right? Some even set up employee stock ownership plans, what we call ESOP, when they go public. In the securities filings, you'll find all those detailed breakdown of salaries, bonuses, perks, stock options, other long-term rewards as well. well. And it's not just for the CEO and CFO and key individuals, but also for the basically three highest paid executives, and sometimes also two other individuals that you'll see there. So the key here is to prove that the compensation is fair compared to the market standards and appropriate for the company's goals and achievement and all that. Now, high pay can raise eyebrows among analysts and investors. Like, see what happened with Elon Musk's compensation plan. I don't know if you followed it, but at Tesla, that's what made him the richest person in the world. So it's important to remember that an independent board committee is responsible for executive compensation. A public company's board of directors has a fiduciary duty to ensure responsible compensation level. Lastly, companies aiming for IPOs, they must prepare for increased scrutiny from the media and all the shareholders. So while shareholders have the executive's best interests at heart, they also closely monitor compensation practices to ensure performance. So it's no surprise when criticism arises over executive compensation policies, but the real question is, can your company strike like the right balance and keep everyone involved happy? That's what it's all about. Next, let's talk about governance and leadership. So you want to go public, right? Well, it's crucial for companies to assess their governance and everything leadership to build a strong management team that can operate the business. You see, potential shareholders, they don't want to invest in, call it a one-man show, right? So the management team, they must be united. They must be sharing, call it a long-term vision that brings the highest possible returns for the company, right? But how do they achieve this? The SEC, they got some guidelines for public companies, like requiring most board members to be independent and also maintaining detailed proxy disclosures for each of their members. But also, depending on whether you list on NASDAQ or NYSE, assuming the US right now, the governance criteria can also vary. Now, some differences might be small, like defining an independent board member, while others can be more significant, like needing kind of like an internal audit. And you might be thinking, okay, so when should I start looking for, call it eligible board members? So the idea is that you never want to wait the last minute, like everything in life, because first of all, prospective board members, they might be hesitant to join right before an IPO, as they'll be responsible for pretty much all the details since the company's inception, right? And they might not like it. So if you're thinking of going public, start considering, the valuable knowledge and diversity you want on your board as your business expands. And it's time to build those relationships as soon as possible. Now, next, let's talk about audit committee, because I don't know if you know that, but setting up an audit committee is a crucial step in meeting governance requirements when going public. Audit committees play a vital role in keeping an organization reporting top-notch and accountable. But what exactly they do? Well, for starters, they make sure financial professionals is appointed within the company. They also have the important task of selecting and supervising independent auditors, which ensure kind of like everyone and everything is in check. They're also responsible for creating protocols that help them engage with employees and tackle other issues relating to auditing, internal controls, or anything accounting, which moves me to the next thing that I want to talk about, which is everything financial planning and analysis, right? So let me tell you a bit of a secret about IPOs. Companies need to develop budgets and measure performance. And that's how a lot of people basically value them, based on their budgets and performance. Why, you ask? Well, underwriters, first of all, demand financial forecasts during the IPO process. So they're interested in connecting an organization's historical success with the previous budgets that they had. So what can a business do? They should establish a financial planning and analysis team to be able to create and manage budgets and forecasts. And when deviations occur, it's important to explain why to everyone involved. Because remember, public companies are often judged by their forecast and profitability. Budgets and estimates in general are essential tools for investors to analyze stock, right? Meeting projections then for a company can greatly influence the stock price, and everyone will look at that. That's why reliable budgeting and forecasting is key for a successful IPO. Now, the public market is unforgiving. You need to remember that. So, punishing businesses that make serious mistakes in this area is very common. Moving me to the next part that I want to talk about, which is treasury. So let's talk about how companies grow and finance their business. Sometimes they look into debt financing, right? Or debt capital markets, which means having a solid funding plan and capital structure plan is crucial to be able to take debt on the business. Company needs to, in general, handle things like interest rate risk, right, and future plans for every shareholder payments, including things like dividend policies and share buyback programs, if you heard about. So when IPOs focus on raising equity, companies often look into the debt market as well, so they must be prepared with all of those options. Now, it's essential for a company to manage financial risks proactively, right, because they should analyze different financial performance, having different KPIs like sales, earnings per share, cash flow, and other related stuff to, let's say, to interest rate, right? Things like currency exchange rates, commodity prices, all those things should be involved, because companies also need insurance coverage for things like collateral damage, business disruption, general liability, employer liability, and other specialized policies. So before an IPO, reassessing the risk profile of the business is a smart move. And you know what else is common? Many organizations get what we call liability insurance covered, especially for their directors and officers, known as D&O. So to sum it up, a company should evaluate and improve their treasury operations, strengthen controls, and use cutting-edge treasury instruments and technology. This helps with cash management, transparency, and decision-making related to finances and risks. Moving me to the next topic, which is let's talk legal. Let's dive into this very important part of the IPO process, starting with finding a top-notch legal counsel, because you see, every public company needs a good legal advice, like SEC counsel and trial lawyers. Usually, also an internal counsel team alone isn't enough, so they get help from external professionals all the time. Think of it kind of like a tag team, right? The internal counsel team provides insights and supervision, while external pros, they lend their expertise on specific things. But also, a public company should also have a compliance team, right? Led usually by the COO or what we call CCO. But a public company should also have a compliance team led by what we call a CCO, the Chief Compliance Officer. This person is like a superhero, thinking about, they always think ahead about potential regulatory threats and other challenges that no one wants to deal with. And their role is to establish and also interpret and track relevant metrics related to it. So it's crucial, to have a strong legal counsel, strong compliance team. Otherwise, going public is going to be very messy. Now, let's talk about internal audits. So it's something that is very essential for companies preparing for an IPO, right? Internal audit functions. Public companies usually need policies and procedures to handle risk, prioritize risks, and also establish formal communication lines with their board about regulatory and anything risk control issues. And it all starts with the board ensuring that management considers and handle risk properly. Now, you might see different compliance roles in companies such as IT, internal audit, and legal stuff as well is involved. So pre-IPO companies often have what we call kind of like risk mitigation and compliance procedures in place, but they might not be formalized or ready for the public company spotlight. Some businesses even subcontract all of those different parts, of their internal audit and enforcement processes. That's something to consider as well. Which leads me to the next subject of investment banks, because building strong partnership with them can boost your reputation and improve the IPO performance. They have experience in marketing, organizing, and underwriting arrangements to generate stock support after you go public. Plus, they're skilled in pricing and presenting your business as a fair and appealing opportunity for investors. So everyone needs a good investment banker. Everyone also needs good media relations, because building a positive public image is crucial for companies preparing for an IPO. A good reputation can help, obviously, with the stock price, customer relations, and many other things. So keep in mind, building that reputation takes time, and it's better to start early, right? Any good PR early is always good. And that's why many companies hire a PR firm to maintain positive external messaging and shareholder relations in the public. They might reach out to analysts, market editors, things like that. They maybe go to trade shows, they maybe advertise to find new employees, they can share news about the company. There's a lot of stuff that a good PR firm can do. Next, let's talk about the corporate strategy and development. Another essential step for a company preparing for an IPO is crafting what we call perfect story for investors. Because the ideal scenario is that you want to create an attractive framework for a company's valuation, which includes things like, first of all, what's your unique business model, your growth strategies, things like predictions and estimates, how you stand out compared to other similar companies. All those things need to be, in order. Also a capable management team that can execute a business model. So the idea here, the goal is to build an equity narrative and give investors reason to be interested in your business. You'll usually find these details in what we call earning releases, right? So initial conference calls, the prospectus, the S1, financial projections. There's also roadshow slide decks and various presentations that companies create in that process. So how would you tell your company's story to make it stand out to potential investors? That's what you need to think about. Next in our list is wealth management and planning, right? So it's a super essential part and step for a company prepared for an IPO. Everything is estate planning. Why is this so important? Well, first of all, it helps align the priorities of the managers with those of the business. Plus, it can lead to significant tax saving. Usually the IPO project leader or HR manager, he guides the executives through this process, which typically includes creating a will, setting up a healthcare proxy, and ensuring strong attorney control over aspects like liquidity, stock options, tax management, charitable donations, and transferring wealth to future generations. And of course, let's not forget that the estate plan must comply with all regulatory requirements. Next, let's talk technology now. So in general, how a company needs to be technology ready for an IPO. Like if you ever thought about whether a company system can even handle the growth and new standards that come with being a public company. That's the biggest challenge that we need to take into consideration here. For example, many businesses, they outgrow their basic accounting software as they expand, right? So to avoid any inaccuracies or delays in reporting, it's crucial to upgrade to some kind of a more advanced system that can keep up with the demand of the bigger business, right? And most companies might or might not be ready for this if they didn't plan for it in advance. What about HR system? In today's, especially in the competitive market, having an efficient and customizable HR system, it's a must. These advanced systems not only help manage any day-to-day tasks, but they also play a huge role in strategic hiring, employee development, and fostering great relationships within the team. And in the end of the day, having access to technology can make all the difference. Next, let's talk about, and not forget, CRM systems. So to keep growing, businesses need to stay on top of current and potential opportunities. A centralized database for all this valuable information is essential for boosting sales and staying ahead of the competition. So as you can see, just being technology prepared is a challenge for an IPO, and it's more than just a single upgrade. It's about ensuring that all those systems work together seamlessly, right? Because we want to support the growth of the company and the success of the company. Another crucial step that a company shouldn't overlook is setting up a solid project management and communication system. Why? Because it's simple. It streamlines any decision making throughout the organization, which is super important. And let me ask you this, have you ever experienced, let's say, a project getting delayed because of some kind of a miscommunication or lack of accountability? And if you experience that, it's frustrating, isn't it? Because that's why having a comprehensive project plan with designated owners and a consistent way to communicate progress is vital for success. A well-structured systems like this ensures maximum efficiencies, transparency, and accountability. And when a company is about to go public, that's precisely what they need to thrive in the, in kind of like the fast-paced world of the business that we're living in. Next, let's dive into building the going public dream team. So an essential step is getting a company IPO ready, is assembling a team with the right experience. People who've been through the process and can help prepare all the necessary documents like registration statements and other. Going public is a massive milestone and it's not easy. That's why you need the best, you want to have the best of the best on your side, right? We're talking about auditors, attorneys, underwriters, accounting consultants, with their expert guidance, you'll be ready to, conquer this IPO world. So it's very important to start to constantly think, who can you bring on your team to help you in each of those steps? Next, let's get back and talk about the SEC for a second, shall we? So like we said, they're like the referees of the public company world, right? Making sure that everyone plays fair. And you better believe that they mean business. I mean, if anyone breaks their rules, the SEC can take both civil and criminal action. So you don't want to play with them. Now, imagine there's some kind of a mistake in, let's say, a registration statement. So that could lead to some serious liabilities, my friend. Even worse, if the SEC spots any errors, they could postpone the IPO and get into even other areas that you don't want to get into. Their job is to review the registration statement and decide whether to give, call it the green light, or put the brakes on a company's plan to sell securities. Next, let's talk about company personnel. So you see, when it comes to preparing registration documents, the level of a company's involvement often depends on the experience of its employees. They've got to be ready to provide all the necessary information for the registration process. But let me tell you, this commitment can sometimes distract workers from their daily tasks. That's why some companies even hire extra hands just to handle the IPO process. Pretty intense. Now, let's move to talk about the Securities Council. They're like, call it the glue that holds the executive team together. Right? So a strong bond between them and the company is super crucial for success here. Now, you want someone who's not only highly qualified, but can also break down, call it complex concepts with ease. And their job is to review tons of data, create documents, and protect the company's interest while working with underwriters and the SEC staff. And guess who's also part of this team? Counsel, of course, right? And counsel for the underwriters, handpicked by investment bankers usually, to help smooth all this IPO process. So it's like, call it kind of like some kind of a one big happy family, right? Everyone working together to achieve this one common goal of going public. Next, let's talk about the investment banker or underwriter. You know, going public without an underwriter is like trying to navigate a maze without a map. It's possible, but it's so tricky that you rarely see it happen. And that's why companies rely on underwriters to guide them through this whole process. These experts ensure that the IPO is handled effectively and the company gets promoted and funded. They work together to plan roadshows, manage risks, and create a syndicate of even more underwriters to draw attention from both retail and institutional investors. So how do underwriters make their money? They can earn a commission, sometimes as high as 10% for smaller or unique offerings, or as low as 1-2% for larger ones. They may also get exclusivity on future stock offerings or even options on the stock. And don't worry, FINRA keeps an eye on underwriters to make sure that their compensation is overall fair. Now, how do underwriters operate? First, they go out there, they commit to buy and sell all the stock in the IPO, and they provide, or this provides in general, some security for the company, knowing the underwriters will buy at least a certain amount, right? Then they do their best to sell even more stock, but with no obligation to buy any unsold shares themselves. And it's pretty fascinating how underwriters play such a crucial role in the IPO. And you'll see that as you start to learn all these different companies that are going through the process. Now, let's mention the capital market advisor. Since the recession days, businesses have started to rely more on capital market consultants to work alongside investment banks. These experts, they offer unbiased guidance on crucial decisions during the IPO process. And what's great about capital market advisors is that they don't conflict with underwriters' banks, and they can help companies call it the most out of their banking relationships. So what do capital markets advisors do? Well, they have two main responsibilities. They help companies plan before approaching investment banks, working on things like the equity narrative and valuation expectations. They also assist in selecting underwriters, figuring out fees, bonus structures, and finalizing subscription agreements. So once the bank is chosen, they also help manage the process. They collaborate with underwriters, they even support marketing roadshows and investor relations. They can also advise on pricing tactics. So based on kind of like, call it demand for the company's stock as well. It's part of what they do as well. Now, let's talk now about underwriters' counsel. They're the legal expert who make sure everything is in order for the underwriting bank. They prepare contracts, review registration documents, and check that everything is complete and accurate. Now, I don't know if you heard about what we call blue sky filings. It's usually prepared by the underwriters' lawyers as well, which lead me to our independent auditors, right? So let's talk about the importance of independent auditors in the IPO process. They play a crucial role in making sure everything is in order. And you know what's important? It's experience, especially for them. You want an auditing firm that knows the ins and outs of public companies, right? They can help your business grow globally and has strong reputation in IPOs and financial markets. Oh, and if they're experts in their company's sector, that's even better. These auditors, they'll provide strategic advice, they'll help prepare the registration statement according to what we call kind of US GAAP and the SEC guidelines. They'll also identify an issue in financial disclosure and reporting. And yes, they'll be auditing financial statements, which can take some time. They'll also work closely with underwriters, assisting the prospectus analysis and respond to any SEC comment. So having skilled auditors is crucial, especially for companies that have never been audited before. Trust me, you'll want to find and fix any issues sooner rather than later. Sometimes companies even hire an additional accounting firm to provide an extra layer of insight and advice on project management, on SEC issues, and financial reporting requirements. They'll also help with compliance, corporate governance, training, your finance and accounting staff, so super important. Next in our team list is what we call a financial printer, right? Again, an essential member of the IPO team, the financial printer. So these specialized printers, they basically handle financial and disclosure documents like registration statements, prospectuses, and more. They're also responsible for filing everything correctly with the SEC through what we call the Edgar system. A good financial printer might even recommend other professionals like different underwriters or lawyers that you can work with. But more than that, companies sometimes hire additional professionals like PR firms specializing in SEC registrations. You even see some hire speech coaches for roadshows, analysts for presentations, and stock transfer agents to handle anything stock related admin tasks. Which leads me to the registration statement and remembering that it's crucial for the company leadership to be involved in the writing process, right? Because they know the business the best. The process is complex and super time consuming, but it's essential to ensure that, that there's compliance with the SEC rules and present the company in the best light possible. That's what every shareholder wants in the end of the day. So the registration statement has two main sections. The first part covers the company's basics like business activities, financial situation, and leadership. The second part includes extra details not required in the main section. And to understand that, it will probably make sense for us to dive into the S1 form a bit more. First up, we have the prospectus summary in there, right? So think of it like call it the Cliff's Notes of the document. It tells you about the company, what they do, the type of securities offered, how much they plan to raise, how they'll use the funds, and the key risks factors. You might even find some financial highlights there. Oh, and also you'll find the company's mailing address, things like contact number, website, all those things. How most of us rarely read more than 10 pages of a book, right? Well, this part is pretty much the same. So it's essential to make it count with this prospectus as well. In there, we'll also want to talk about the risks tied to the business. So risk factors are unique to each company, of course, covering all kind of unpredictable or risky aspects. So this could include things like recent setbacks or losses, the need for additional financing, how public investors might be affected, industry trends, info on competitors, dependence on specific clients, suppliers, or employees, details about contracts or licenses, current or planned legal and technological shift related to the business, right? So all those different things that you'll find there as well. Which will bring me to the next part of the prospectus, which is the use of proceeds. Now, what will the company do with the money they raise? You might find things like business acquisitions, reducing debt, capital investments, R&D, advertising spend. Moving on, we have the dividend policy and restrictions in that document. Here, you'll see the company shares their current dividend policy and their plans for some potential policies in the future. And then there's dilution. So this happens if there's a difference between the IPO price and the net tangible asset value. Companies need to show the impact of dilution on potential investors, often in some kind of a table format that you'll find it. Next, we find details about underwriting and distribution of securities. You'll see the pricing of the issued security, info on the underwriters, the type of underwriting, and any connections between the company and underwriters. Finally, you'll get an overview of the company's business and expect to see their business plan, a summary of key divisions, services, and products they sell, as well as info about properties, international operations, R&D, investments, industry regulations, and company performance. They might also cover future clients, stock, trademarks, vendors, and the competitive landscape in their major industries and geographical segment. So there's a lot here. Probably want to take a moment to digest all of this, but we're also going to move fast to the next part, which is the financial information in the prospectus. So the SEC has specific and sometimes complex guidelines for the financial reports that must be included. Now, don't worry, consultants and accountants help with this, but what you can expect to see in there is audited balances for the last 2 fiscal years, audited accounts of revenue, cash flows and equity adjustments for the previous 3 fiscal years, specified financial information for the previous 5 fiscal years, provisional financial reports if the most recent audited reports are, let's say, over a year and 45 days old from the registration statement, financial reports of companies acquired or about to be acquired. You might also see some, call it across pro forma data, which shows financial reports as if certain transactions or activities already took place. So all those things are going to be involved. Again, some of those things you don't need to be to understand all of it, but it's good to know that it's there. Next, let's talk about the company's officers, directors, and principal shareholders. The prospectus shares info about them, their holdings, and various deals and compensation. The SEC requires disclosures on directors' pay and any related matters for the last 3 years. So in there, you'll find things like the detailed info on, first of all, the executive officers like CFO, CEO, a section about management responsibility, compensation board, and different methods used to assess executive pay. You'll see a summary table of pay, including salaries, bonuses, stocks, different rewards, optional rewards, non-equity compensation, pensions, and other different perks. Amounts owed to officers if some kind of termination occurs. There's a lot of information, isn't it? But which part do you think is intriguing the most in here? Because everyone will look at something differently here. Moving me to the next part, which is the MD&A segment. In this part, management provides investors with information about the company's financial situation, operating performance, and liquidity. And here's what you'll find in here. Things like, first of all, the results of operations, right? So factors behind any positive or negative trends or uncertainties that could impact the company. Liquidity, so any known factors that may lead to the company's liquidity issues. Capital resources, so a summary of capital expenses, obligations, and estimated sources of funds to meet those obligations. Off-balance sheet processes and contractual commitments. Descriptions of agreements and relationships that could affect the company's financial situation. Key accounting policies and projections. Details on the consistency or uncertainty of company's financial situation and operational effectiveness. Market risk disclosures, so a quantitative and qualitative review of the company's key risks, foreign exchange, commodity prices, interest rates, and other market risks. This section also explains how the company manages these risks. If it's not enough to go through all that, there's also part 2 of the prospectus. In this section, we'll discuss the cost related to the offering and delivery of shares, compensation of directors, officers, employees, and other transactions during the past 3 years. Although it's not officially required, this information is often included here. So let's talk about how to navigate this whole IPO process, because successful IPOs usually come from companies that act like public companies well before going public. So what makes their IPO process seamless and productive? So here are some key factors to consider. Starting with early preparation, right? So companies often start preparing 6 months to a year before the IPO process begins. Engaging underwriters. So the IPO process kicks off when a company signs an agreement with their underwriters. This is then followed by a quiet period to ensure compliance with the SEC rules. Balancing activities. So companies must keep their business running while working on tasks like creating the preliminary prospectus, assisting with underwriters' due diligence, and developing roadshow marketing materials. The whole process typically takes 3 to 5 months from the first filing until the company collects funds from the offering. The process often starts with an all-hands meeting where participants from different areas involved in the IPO gather together and then they discuss the offering details. So in those kind of meetings, you'll see there's conversation about the minimum size of the offer in terms of shares, target pricing range and pre-IPO stock sale discussions, fees and costs for the process, use of funds raised, allocation of shares and lockup period discussions, early holders privileges and cash out plans during or after the IPO. So a lot of things are going to be discussed to make sure that the shareholders are going to be happy if and when the company is going to be public. Moving me to the next part, which is the due diligence period. So during this phase that we call due diligence, lawyers and underwriters, they closely examine various aspects of the company. They'll inspect locations, review crucial contracts and agreements, financial records, tax reports, and meeting minutes of shareholders and the board of directors. They'll also evaluate the company in the market to ensure that there are no material errors, oversights, or contradictions. Lawyers typically, what they do is they basically go out there and they send you a questionnaire or to the company, and then asking them to review and comment on the details in the registration statement draft. Underwriters will also wait for comfort letters from external auditors as part of their due diligence process. So that's part of it as well. So if you're the owner, you need to expect a lot of questions during this time, and everyone involved, at the end of the day, they want to get a clear understanding of the business. So can you guess which part of the due diligence process might be the most challenging for companies going public? What do you think is the most challenging here? Moving into what we call the waiting period. Now, this waiting period, also known as cooling off period, this phase starts and lasts until the registration date. There are limitations on what the company can do during this time. So for example, underwriters can get an interest for the company, but actual transactions can't happen until the effective date. So that's something to consider. So during this period, you also start going out there and responding to SEC letters, right? The SEC staff usually issues a comment letter after the initial registration, pointing out some kind of concern, potential shortcomings, and recommended call it amendments. So generally it takes around 30 days from the initial registration for the SEC staff to perform their analysis and issue whatever comments they have. You can expect multiple follow-up letters and comments, which typically take, let's say, a week or two. Now, the company must also file with FINRA during this period in the states where it plans to sell securities. This process needs to be done at least 15 days before the roadshow date, which lead me next to discussing financial analyst meetings or roadshows. So the underwriter, what they do is they arrange meetings with financial experts, dealers, and prospective institutional investors for potential shareholders to learn about the business, right? They want to sell the business in the end of the day. So top executives usually attend this discussion, which can take place at various locations across the globe or even on Zoom calls nowadays. Basically, companies can literally go public on Zoom. The management team needs to be well prepared and organized for these meetings, as they can't solely rely on the prospectus. So they must be able to answer all the possible questions about the company specific, and their ability to respond well can significantly impact the IPO process. You saw it in WeWork. Adam Neumann didn't really sell himself well and it blew up. So roadshows are a crucial part of the IPO process and can be quite intense. They may involve several meetings a day and last up to 2 weeks. Underwriters play a vital role in this training and management team and helping to customize the presentation for specific investors. So it can be super exhausting period for the management team during this period, and you need to be prepared for it. Moving me to the next topic, which is let's discuss what we call signing the price amendment and underwriting agreement. So this arrangement and financial decision for the IPO's terms depend on factors like company's current results, market conditions, investor interest from the roadshows. So underwriters will also consider comparables organizations, right, in the market like other companies to eventually settle the offering price of the IPO. Timing is crucial also. For example, companies going public during the dot-com bubble would achieve higher offering prices than those in, let's say, the 2008 crisis period. So overall market sentiment can also affect stocks. You need to be aware of it, as some sectors experience hot and some kind of cold cycles. After completing the roadshow and considering all factors, the underwriting contract is finalized, signed by the company's official and underwriters, and submitted to the SEC. If there are no major concerns, the company and its underwriter will request the deal to be deemed effective immediately, also known as seeking acceleration. So if approved, the underwriter can then proceed with the sale of the securities to the public. Typically it takes, let's say, 3 to 5 business days to get things started if everything is okay and approved. But the journey doesn't obviously end here, right? It's pretty much just the beginning for the company, because preparing for the life as a public company is essential then, right? So as it brings obviously great public oversight and ongoing responsibilities. Non-compliance with regulations then can harm the company's reputation, possibly result in lawsuits and affect the stock price. So all of these needed to be taken in consideration. So when you're public, what are the reporting obligations? Under the 1934 Act and Sarbanes-Oxley, public corporations must submit regular updates to the SEC to keep the investing public informed. Ensuring they fulfill these responsibilities becomes a top priority for any company going public. Can you imagine the pressure of being a public company, constantly under scrutiny and having to comply with numerous regulations? That's the decision you need to make if you want to play with the big guys, right? So next, let's move on to the next stage, which is signing the price amendment and underwriting agreement. So let's understand what that looks like. So how does a company decide on the IPO terms and agreements? It's based on a few factors like current business results, market conditions, and interest from investors during the roadshow. Underwriters also look at similar companies in the market, like we said, to help set the offering price. And like we said, timing is crucial as well. Remember the dot-com bubble we mentioned, right? Companies back then got higher offering prices than during the 2008 crisis. Market sentiment also impacts stocks as sectors go through hot and cold cycles. So once the roadshow is done and all factors considered, the company and underwriters, they then finalize and sign the underwriter contract. It can include details like the offering amount, underwriter fees, and company's net proceeds. Then they submit it to the SEC. If there aren't any big concerns from the SEC, the company and underwriter requests the deal to be approved right away. This is called seeking acceleration. If approved, the underwriter can start selling securities to the public in 3 to 5 days. Things can get going, and now it's time for the life of a public company, the IPO. Like we said, the IPO is just the beginning. Public companies face more oversight and have many ongoing responsibilities, and failing to comply with regulations can damage the company's reputations, which lead to lawsuits and affect the stock price. So what about reporting obligations? Under the 1934 Act and Sarbanes-Oxley, public companies must submit regular updates to the SEC to keep investors informed. Now, let's discuss the SEC designated feeler status. The SEC sorts companies into 3 groups based on size, which determines the deadlines for submitting forms. So while lawyers and accountants can help figure this out, let me go through those groups, right? Starting with 700 million or more. So then you have between 75 and 700 million. Then you have a group below 75 million. Many businesses face the challenge of closing or reporting financial statements on an accelerator schedule and meeting the Sarbanes-Oxley requirements. Failing to do so could erode investor trust and even lead to delisting from the exchange. That's why public companies need enough accounting staff, legal counsels, and independent auditors to meet all the reporting standards. Which lead me to the next topic about the idea of working with investors as a public company, because public companies need to protect themselves and maintain investor excitement, or trading may just decrease if interest warms down, right? Getting help from financial public relations firms is essential, as is having an aftermarket plan. Companies typically assign someone to manage everything, shareholder relationships, and get external support for regular news releases with, the right information. And the company's success is reflected by its stock valuation, of course, and management, they must balance, call it short-term efficiencies with long-term goals. In order to keep the investors happy, companies should regularly ask themselves, like, is the business showing steady or growing, growth that appeals to investors? They need to ask themselves, are the company's products or services still relevant and generating public interest? Because public perception affects stock value. Just look at Tesla. Is the leadership team still competent and dedicated? Because the management team and CEO play a crucial role in the success of the business. So it's vital that they remain creative, dedicated, and capable. So what are the strategies that you think are the most important for maintaining investor trust in a business? Every investor is also looking at the business differently. Moving forward, let's talk about NASDAQ and NYSE. So starting with NASDAQ. What is NASDAQ, you ask? So to start with, it's the world's second biggest stock exchange by market value, just behind NYSE, with over 3,000 businesses listed and daily share trade volume of over 2 billion. It's a powerhouse, right? And guess what? No other exchange deals with more IPOs than NASDAQ, over 1,000 IPOs since 2000. Now let's break it down. NASDAQ stands for National Association of Securities Dealer electronic quote. Founded in 1971, it was recognized by SEC in 2006. Favored by electronics and biotechnology companies, Nasdaq has a whopping total market cap of over 8.5 trillion. And Nasdaq also have different levels. So they have Nasdaq Global Select Market. That's the most stringent listing criteria. They have Nasdaq Global Market for companies with international presence, and they have Nasdaq Capital Market. Now, each level has unique listing requirements. And what does it take to be listed in Nasdaq then? For the Nasdaq Global Market, companies must meet at least one of these 4 conditions that we'll go through. For more details, of course, you can check Nasdaq listing rules online on their website. So first, pre-tax earnings, 11 million or more in the last 3 years, with each year being positive and the 2 most recent years at least 2.2 million each. Cash flows, aggregate cash flow of 27.5 million or more in the last 3 fiscal years, with each year being positive. Market cap needs to be over 550 million in the last 12 months. Revenue over 90 million for the previous fiscal year. Additionally, there are liquidity requirements like having 450 plus shareholders or a market value of unrestricted publicly held shares above 45 million. Companies must also have a minimum trading volume of 2,000 shares and a minimum 4 million underwritten public offering. Finally, they must comply with the $75 million market value of listed shares and the $4 bid price minimum. Next, let's look at the requirements for the Nasdaq Capital Market. For companies to be listed, they must satisfy at least one of the next 3 requirements. So either 5 million shareholders equity, market value of at least 15 million of unrestricted shares, operating history of at least 2 years. Other requirements include market value of at least 50 million of listed security, net income from operations of at least $750 in the last year or in 2 of the last 3 years, at least 300 shareholders, and 3 market makers with a bid price of at least $4 or a closing price of at least $3. A company must also have an average yearly sales of 6 million for 3 years, or 5 million worth of net tangible assets, or 2 million worth of net tangible assets, and a 3-year operating history. In addition to meeting the other financial and liquidity conditions mentioned above, to be eligible for an alternate closing price. The security must have an average regular trading volume of 2,000 shares over a 30-day trading period leading up to the listing, unless the security is listed on the exchange in relation to the minimum of 4 million underwritten public offering. Now, let's talk about corporate governance requirements. So now, as for the listing rules out there, companies listed on Nasdaq must follow high corporate governance practices. I'm talking about things like distributing annual or interim reports via the company website that are going to be accessible to shareholders, of course, having an audit committee composed of at least 3 independent directors, having a compensation committee with independent directors to decide on the pay for the CEO and other top executives, having the nomination of directors picked by independent managers, implementing a code of conduct, organizing annual shareholder meetings within 1 year after the fiscal year, soliciting proxies, monitoring and analyzing related party transactions to avoid conflict of interest, obtaining shareholder approval for certain actions like buyouts, power shifts, equity compensation, and private assignments. Also, ensuring that voting rights of current shareholders are not disproportionately diminished or limited by corporate acts or issuances. So, getting listed on Nasdaq is not walk in the park. Nasdaq has at least basically 12 different listing procedures, and they require a bunch of forms and fees, right? Next, let's talk about those Nasdaq application requirements. So companies need to submit forms, pay entry fees ranging from $50,000 to $250,000, and meet corporate governance standards. It's a lot of work, but it's obviously worth because it allows you to join this exclusive club, right? But what if you're eyeing the NYSE instead? So the New York Stock Exchange is the largest and older stock exchange in the world. It's known for attracting businesses in banking, industrial, and energy sectors. The NYSE also has its own set of rules for getting listed. You'll need to show strong financials, a large market cap, and a higher share price. It's not easy feat, but it's the ultimate goal for many companies. Which stock exchange would you choose for your company? Would it be NASDAQ, NYSE? Let me know, I'm just curious. If you had the option, which one would you choose? And look, the process to go public usually takes at least 6 months, but the actual time can obviously vary depending on the companies. And we're going to cover 7 key steps that are involved in the process. And we're going to dive in even more into each of those, right? Starting with choosing the IPO underwriter, the due diligence process, the IPO roadshow, the IPO pricing, then the IPO stabilization, and then the process of transitioning to market competition. So step 1 is finding the right IPO underwriter. We talked about it a little bit, but we didn't expand on it. And you need to understand this is a crucial point in the process because a good underwriter can make or break your IPO. They should be an investment bank registered with the SEC, with great reputation, research quality, and expertise in their sector ideally. Their network distribution, reach, and previous relationships with companies are also important factors. Now, with underwriters, underwriting an IPO can be lengthy and expensive process, but it's essential for success. Many companies choose even up to 3 banks as underwriters and even few more as what we call co-managers. For bigger IPOs, you'll see those numbers are even, can even be higher. The underwriting team's role is to make sure that shares are sold at the right price. They typically charge around 3 to 7%, depends on the deal. And they take it from the overall purchase price of the IPO for their services. But remember, a successful IPO can be life-changing for your company. So, they deserve that money. Depends who you're asking. Now that you understand this process, the next, do you understand the idea of getting underwriters? The next step would be due diligence, right? Because if you have your underwriter, what's next? It's time for due diligence. Underwriters play a crucial role as, call it, intermediaries between the company and the public investors. They help the issuing company sell its initial shares. But then the question is, okay, so how do they do that? And that's what we're going to do right now, right? So there are a few different types of agreements that a company can have with an underwriter. First of all, there's the firm commitment. So the underwriter, when there's a firm commitment, the underwriter will basically go out there, buy all the shares, and he resells them to the public. This also guarantees the company some amount of money. Then there's what we call best efforts agreement. In this case, the underwriter sells shares on behalf of the company, but there's no guarantee on the amount that they'll collect. And then there's also the all or none agreement. So there's no deal, basically no deal is made unless all the shares are sold. So it depends, everyone have different agreements with the underwriter. So it's important to understand those different ways. But what if the risk is too high for just one underwriter? That's when a syndicate or underwriters comes in, right? So what they'll do is a group of banks form a coalition led by one main investment bank, and then they share the risk together. And now with this in mind, let's talk about the documents that you'll see from your underwriter. So starting with the engagement letter, this includes the reimbursement clause, meaning the issuing firm must pay all out-of-pocket costs, even if the IPO is canceled. And the gross spread usually set at 7% of earnings to compensate the underwriter. So if you ever wondered how companies and underwriters work together during an IPO, now you know. But remember, this is just step 2, right? Obviously, more steps involved, which leads me to, let's talk about exactly what are some of those underwriter documents, right? Which a very important one is the letter of intent, the LOI. In this letter, you'll typically find things like the underwriter's commitment to enter a subscription agreement with the company's pledge to provide all relevant information to the underwriter and cooperate fully in due diligence, the company's commitment to include 15% over allotment, which is basically allows underwriters to issue up to 15% more shares than originally planned. And keep in mind that the letter of intent doesn't mention the final offering price, right? Just know that. Next comes the underwriting agreement. This kicks in after the stocks are priced, replacing the letter of intent we just talked about. Next is the registration statement. This one contains details about the IPO, the financial reports, management history, insider holdings, legal issues, and the company's ticker symbol. The SEC requires this statement, which has 2 parts. First, the prospectus. This is a public document that explains the company's situation, financials, risk factors, and leadership. Then we got the private filings. This information is for the SEC, but usually not available to the public. And the registration statement ensures investors have enough information about the security. The SEC then conducts its own due diligence to confirm everything is disclosed properly. So after knowing all that, next step would be the IPO roadshow. Now you might be wondering, what's the roadshow? We mentioned that, but let's dive into it. Well, roadshow or the roadshow is like a promotional tour for the company's IPO, sometimes called a dog and pony show. And it lasts about 3 to 4 weeks and helps determine investors' interest in the company's shares. During a roadshow, the company's top leaders get the chance to speak to investors and then obviously sell their vision. The goal is to create as much excitement as possible. And you know what? Nowadays, I mean, like I said, many roadshows are conducted online through live conferences and Zoom calls, especially thanks to the pandemic, which is pretty amazing. And the fact that you can go public, never seeing anyone in face to face. So what the shareholders present, or the CEO usually present in the roadshow, it's all about showcasing the company's history, the plans, the ambitions, and they use usually some kind of engaging presentations or videos to make their case. And there's usually a Q&A session for investors to ask about the company's background, management, and future projections. Kind of like a bit of a Shark Tank, but for companies that want to be public. After the roadshow, the company finalizes its IPO prospectus, which the SEC reviews. Once approved, it's made available to all potential investors. So in a nutshell, roadshows are super essential for, call it, drumming up interest in the IPO and letting investors interact with the company's management. Next, let's talk about the IPO pricing. Again, just doing a bit more of a deep dive if you're still here. So once the SEC approves the IPO, the company and the underwriter need to set the offering price a day before it goes live. If you're wondering why it's crucial, well, this is the price the company will sell their shares at. So obviously it's important. Now, several factors influence the final offering price, such as the company's value, the economic conditions, the issuer's reputation, their goals, and the IPO roadshow success, of course. So the CEO needs to sell himself in the end of the day, like any business. Now, here's the little secret. Companies usually price their IPOs lower than their actual value. Why? You ask, because they want to ensure that the issue is fully subscribed and ideally oversubscribed by public shareholders. So it creates an expectation that the share price will rise on the first trading day, which obviously is going to drive more demand. And an IPO can be considered good if it's oversubscribed by at least 2 or 3 times. So how about that? The art of IPO pricing is all about striking the right balance and creating excitement in the market. If people want to be involved in the business, the price is going to be basically determined based on that, right? Moves me to the next step, which is for the IPO to go public, right? So the underwriter will then release the shares to the public on the agreed date, and the company's stock will be listed on an exchange for the first time, right? So remember, company goes public. It's a great opportunity for them to raise money, because taking a loan from a bank might sound like a good idea, but those monthly payments when you take a loan from a bank can be super stressful on a business, especially in uncertain economic times. So going public, remember, helps us to avoid this, because investors don't need monthly payments, right? They're in for the long run, they have equity, and there's no debt payment. That's the idea of going public. Instead of going for private investors, you go to the public. However, going public obviously comes with a lot of challenges, right? Remember, companies face all the legal obligations, governance conditions, and a lot of time consuming disclosure standards. Plus, they'll be under, call it, the watchful eyes of tons of analysts, media, and share price fluctuations. Usually, a company starts considering going public when they need capital to expand or want to create an exit opportunity for existing employees and investors. And this is where the investment bankers that we talked about really comes in and help. They help the company make crucial decisions about the share value and aiming for the highest possible sell price, but without over-exaggerating it so no one will buy it. So while going public has its perks, like accessing cash, the ability to make acquisitions, broadening ownership, and raising credibility, it also has some downsides, right? Increased pressure on short-term growth plan, higher costs, more constraints, public disclosure, and sometimes less decision-making power for the business owner. So all of those are part of the package. So you need to really decide if you want to do that. But again, do you want to play with the big guys or not? So are the benefits worth the challenge? Depends who you're asking. That's a big question companies must answer before taking that leap into becoming, into going into this public sphere. So let's recap the essential steps for a company to go public in a simple and engaging way. Stable and predictable income. Public investors value reliability. Companies should be experienced enough to accurately forecast revenues for upcoming quarters and years. Financing the IPO process. Remember, the IPO process isn't cheap, right? And you can't use the money raised to cover these expenses. Growth potential. Investors want a business with secure earnings today and plenty of room for growth in the future. If you don't have an amazing idea for the future, it's going to be very difficult. Be an industry leader. Investors will compare your company to others in the same industry before committing their money, right? So how are you going to be different than others in the space? Competent management team. A strong leadership is vital for your company's success. Then we got audited financials. Your financial records must be checked thoroughly. Then we have the idea of building robust business systems, because everything in your company will be scrutinized. So your systems must be solid. Also, another important thing is your low debt to equity ratio, because heavily leveraged companies, they might struggle to sell their stock at a good price eventually. Long-term planning. You should have a clear 3 to 5 year plan and a strategic strategy. If you don't have a good plan, investors won't believe in you. Strong leadership. Behind the financials, investors will assess the quality of the management team to decide if the investment is even worth it. To sum it up, many underwriters look for companies with revenues of 10 to 20 million, income of 1 million or more, and a management team that can deliver growth of at least 25% per year for the next 5 to 7 years. There are exceptions, of course, but there is no denying that companies need to work hard before reaping the benefits of going public. And you gotta be at a certain size to be able to go to the main exchanges, right? So all those things you gotta keep in mind. Let's move to the next step, which is the IPO stabilization. So, after the IPO, the underwriter has an important role in advising and creating a market for the newly released stock. There is what we call a 25-day quiet phase where underwriters can actually control the share price without any legal issues. So imagine this. It's like the underwriter pretty much has some superpowers to balance things out in case there are other imbalances. And what happens is that they can go out there, they can even buy securities at or below the offering price to stabilize the market, right? But they can only do it for a short time. So during this, what we call the quiet phase, underwriters can use different strategies for IPO stabilization. And one popular way is the over allotment or green shoe option, if you heard about them. It's like a secret weapon that allows underwriters to sell 15% more shares than initially planned, but only again within these 30 days of the offer. The IPO underwriting contract has all the details about this if you want to see. So if the demand for the shares is higher than expected and the selling price skyrockets, underwriters can use the over allotment option to issue even more shares. So it's like a risk-free SEC-approved trick to control the stock price. But not every company will go for the green shoe option. Sometimes businesses have a clear target for the IPO returns and don't want to raise more cash than needed. So they'll try to avoid using this secret weapon. Next reason for over allotment or green shoe is when price exceeds the offer price. And with that, let's continue to dive into another reason for over allotment or green shoe options. When the price exceeds the offer price, like imagine this scenario for a second, there's a huge demand for a company's shares, which drives the share prices higher than the initial offer price. In this case, underwriters wouldn't want to buy back the stock of at the current higher market price since they would lose money, right? But they have a plan for this. They can use their over allotment option to purchase additional shares at the initial offer price. Sounds interesting, right? Let's look at a real life example. So Facebook's IPO in 2012, they sold 421 million shares to underwriters at $38 per share. So these underwriters were a group of investment banks that helped sell the shares, with Morgan Stanley as the main underwriter. They earned 1.1%, by the way, of the sale in return. So when Facebook stock started trading, the price jumped to $42.05, an 11% increase over the IPO price. However, the stock quickly became unstable and the price dropped back to $38. So to handle this, the underwriters sold a total of 484 million Facebook shares for $388 million. So what happened here? Basically, the underwriters used their over allotment option to sell an extra 63 million shares. Then they stepped in and bought more shares because they wanted to stabilize the price. To cover any losses from stabilizing the rates, they could buy back the extra 63 million shares at $38 per share, which ensuring more stability in the market. So it's crazy how it all works, right? Now, have you ever wondered about the role of underwriters in the IPOs? Can you see right now how crucial their role is? Let's talk about the lockup period in the world of IPOs. So imagine you own stocks in a company that's about to go public. You think you could just sell them right after the IPO, right? Well, that's not exactly the case, because in a traditional IPO, you can only sell your stocks after something called lockup period. This is a time frame where employees, investors, and insiders can't redeem or sell their stocks. It usually ranges between 80 and 190 days, but it can be longer for different IPO types like SPACs, right? Now, why have a lockup period in the first place, you ask? It's to prevent insiders from selling their shares right after the IPO, which helps reduce selling pressure during the company's early days as a public entity. Now, this applies to people like employees, managers, owners, and founders of the business. And let's do a bit of a more deep dive even deeper into why IPO lockup period even exists. Because the main goal is to stop large investors from overwhelming the stock market and weakening the stock initial price. You see, companies' insiders tend to own most of the shares compared to the general public. And if they all sell their shares right after the company goes public, then it can dramatically affect the share price. So lockup periods also help avoid creating an impression of, call it a lack of confidence in the company's future among insiders. Sometimes insiders just want to cash in on their long-awaited gains from owning shares for so long. And even after the lockup period ends, insiders might still be unable to sell their stock. This could happen if they have access to what we call non-public information that could lead to insider trading. Now let's talk about the legal status of IPO lockups and how they affect what we call option strategies. So surprisingly, the SEC doesn't legally require lockup periods. They're actually created by the company itself or by the investment bank with the goal of maintaining high stock prices when a business goes public. You can find information about company's lockup period, by the way, in its S1 filing. So many investing pros, they believe that investors should wait until the lockup periods ends before investing in newly listed companies. This is because new stocks often experience a price drop when insiders offload their shares after the lockup period, which create an opportunity to buy shares at a discount. The IPO lockup period can have an impact on the options market as well. Options aren't available on the day of the IPO, but become accessible before the end of the lockup period for large and mid-cap firms. So if investors are worried about a possible decrease after the lockup period, they might buy protective puts. Take Facebook, for example. When they went public, there was a lockup of 268 million shares. On the day of the lockup ended, the stock price dropped to an all-time low of $19 per share, around 50% less than the share price when the company went public. So in a nutshell, an IPO lockup period is a restriction that prevents business insiders from selling their stock for a specific time after the company goes public. The main goal is to stop insiders from selling too much stock, which could lead to a low stock price due to a massive influx of sales. Companies and bankers do this because if insiders sell their shares, it can basically make other investors think that the business just isn't worth much. So now we've reached step 7 in the IPO process, which is the transition to, call it, market competition. So this phase begins 25 days after the IPO, when the SEC required quiet period ends. At this point, investors need to rely on market forces to decide if they like the company or not. During the quiet period, investors relied on the prospectus to determine the company's value. Now, it's all about the relationship between the company and the public. The cards are on the table, and it's not just for those who had early access to the prospectus then. But how can we evaluate if an IPO is successful or not, right? So let's look at a few different ways. So assuming the IPO went through, what's the case right now? First, we'll consider the market capitalization, so the market cap. If the company market cap is equal or greater than its competitors in the same industry, then the IPO is likely successful. To calculate market cap, by the way, if you don't know, you multiply the stock price by the total number of shares. You can also search online just search for a company name followed by market cap on Google, and you could easily find this information. Another way to figure out if an IPO is successful or not is by checking the gap between the company's issuing market cap and the offering price. If this gap, let's say, is less than 20%, it could be considered a successful IPO. Now it's time to understand the costs of the IPO. So let's dive into some of the costs in the IPO process, which can be quite expensive due to the complexity dealing with the SEC. So we'll explore all of those in 4 main categories of the IPO cost. We're going to go through the pre-IPO direct cost, the pre-IPO indirect cost, the post-IPO one-time cost, and the post-IPO recurring costs. First, let's talk about underwriting costs. So hiring an underwriter typically costs 5 to 7% of the offering. We mentioned it already, depending on the industry, market situation, and offering size. Big names in this field include, maybe you heard, Goldman Sachs, Credit Suisse, Morgan Stanley, Merrill Lynch, and JP Morgan as well. The underwriting fees is the largest direct expense in the IPO process. Now, let's discuss legal fees. Obviously, these are needed for both the company's outside counsel and the underwriter's counsel. So the fees are influenced by the same factors as underwriter costs and can range from $500,000 to $1.5 million. These legal fees cover the creation of offering documentation and guidance on relevant contracts. Auditor costs come next. Every company going public needs an auditor. They'll work on a year-end audit for the SEC, provide a comfort letter to underwriters, and evaluate the registration statement and other relevant documents. Auditors' fees range from $500,000 to $1.2 million, depending on the offering size. You may have heard of the Big Four, which is EY, KPMG, PwC, and Deloitte. They're the giants in the auditing world. Next is printing expenses. Sounds surprising, right? Well, printing will cost you between $300,000 and $500,000. This includes planning, delivering, and managing marketing materials, SEC filings, and other paperwork. Specialized services like this are super essential for a successful IPO, as weird as it sounds. And lastly, we have listing fees. For the NYSE, there's an upfront application fee of $25,000, a per share fee of 0.004, and a one-time payment of $50,000. The base listing fee is $150,000, while first-time issuers may face what we call a peak charge of $295,000. So in total, you can expect to pay around $350,000, and Nasdaq follows a similar pricing model, also depending on the company's size and market. Next, let's explore the world of roadshow costs. So during a roadshow, which usually lasts 1 to 2 weeks, companies need to cover expenses like flights, accommodation, and local transportation. And since each business chooses different venues and arrangements, this cost can vary greatly. Obviously, if you go to a super expensive hotel, it's going to cost you very differently than a motel. All right, so moving to a pre-IPO indirect cost, these are unique to each business and can be hard to estimate since they don't appear in the registration statement and we can't really access and check those. But these costs include everything related to preparing the business and restructuring it for the IPO. I'm talking about legal, IT, HR, audit, and financial consultancy fees. Additionally, companies must establish internal teams, introduce new accounting and reporting systems, develop employee benefit programs, and also record internal controls. Now, the time required for restructuring will dictate the size of this cost. Don't forget also that the expense to make financial statements, right? So the SNX compliant and obtaining valuation services, reports, and article of incorporation. All of those are part of the expenses too. And lastly, let's discuss post-IPO, but the recurring cost right now. So according to PwC, over 60% of newly public companies spend more than $1 million per year or on just recurring expenses. And these are costs that come with basically you stay in public company. Those are going to be your ongoing expenses just for being a public company. So now that we've covered various IPO costs, let's discuss what leads to these increased expenses after going public. First up, new staffing expenses. So public companies need to create and organize new divisions, which obviously means recruiting, training, and retaining new employees, especially in accounting, finance, and legal departments. So although the cost of new hires varies depending on your business, preparing for these expenses is crucial across all industries. So let's talk about advisor fees for tax, accounting, and consulting services. So public corporations face lots of scrutiny. So they often hire third-party consultants to maintain reliable records. I'm talking financial reporting, regulatory enforcement, and increased auditing costs contribute to the recurring expenses of being public. Another factor is unexpected organizational costs, right? So many CFOs, you'll hear them admit that going public was more expensive than anticipated due to some kind of unforeseen expenses, because companies must be prepared to handle this cost to keep investors and lenders happy. So those expenses are going to happen if they want it or not. We should also mention that post-IPO one-time cost, which can be as high as $1 million, these expenses include new financial reporting systems and implementing new controls. Companies need to pay for professional accounting consulting services because they need to introduce, new internal or just overall internal controls and updated reporting systems, as well as IT consulting fees for deploying, integrating, and testing these systems. So going public is going to involve a lot more hidden costs than most would assume. And it's essential for companies to be prepared for the challenges they'll face on this really exciting journey, as weird as it seems to. But as we continue learning about the IPO expenses, remember that understanding all those details, it's power, because you can really prepare yourself in advance. So being prepared and being aware of these expenses help companies make informed decisions and ensure that they're ready to face the challenges of becoming a public entity. So let's really do a bit of a recap on the main factors contributing to the increased expenses after going public. Right? We're talking about new staffing expenses, creating new divisions and hiring employees for accounting, finance, and legal departments. Advisor fees, right? So hiring third-party consultants for tax, accounting, and consulting services to maintain reliable records. We have unexpected organizational costs, right? So unforeseen expenses that often surprise CFOs and require companies to adapt really fast. Post-IPO one-time costs are things like implementing new financial reporting systems and also internal controls, which can be as high as $1 million. Which moves me to the next topic, which is timing, understanding timing when it comes to IPOs. Many companies wait for the right moment to go public, as market timing can impact millions of dollars in financing. Businesses often look for windows in the market to optimize their value during an IPO. I'm talking about factors like volatility index, industry competitiveness, and recent IPOs in your industry can influence your decision making. So first, let's discuss the volatility index. If you never heard about it, the CBOE volatility index, basically the VIX volatility index, tracks investor expectations of volatility in the S&P 500 for the next 30 days. And it's an excellent indicator of an open IPO window. So the VIX, often called fear index, measures investor anxiety. So when the VIX is above 20, IPOs tend to decrease, while IPOs increase when the VIX is below 20 for a prolonged period. Companies going public during these windows can benefit from increased demand and basically some more kind of a favorable pricing. So let's understand for a second how different players respond to risks and uncertainty based on those things. So starting with institutional investors. Institutional investors, they want to get a payout that compensates them for the risk that they're taking by investing early in an IPO. So in a volatile market condition, the risk for investor increases, pushing up basically the necessary returns and leading to a larger discount on the company stock. When the market is unpredictable, businesses might not be able to lower the stock price to a level that is attractive to investors, so they wait for a steadier condition. So when considering the right timing for an IPO, it's essential to keep an eye on the market conditions and understand how different players react to risks and uncertainty. And by doing so, you can make a well-informed decision that maximize the company's value in the public market. And do you think that, timing is everything when it comes to going public? Some would say yes, some would say no. But let's continue to explore this world of IPO so you understand more angles on if and when it makes sense to think about timing at all. Because I'll tell you this, you're definitely not alone if you're waiting for the perfect moment to go public. Market timing is a big concern for most companies. They look for market windows to optimize their business value. Next, let's talk about corporate readiness and when it comes to IPO, and it can be divided into three categories. Starting with, let's call it practicalities. So just like we talked about earlier, every company has to deal with organizational and logistical tasks before launching an IPO. We're talking about financial audits, getting the right people on the board of directors, and so on. Then we have what we call Wall Street readiness, right? And trust me, predicting sales and expenses can be tough, but it's even tougher for public companies, because if a business struggles to make accurate predictions while being private, it might be better to hold off going public until they've got that figured out. Changes in model and valuation, that's another thing to consider. Remember the challenges company faced during the pandemic? Forecasts became difficult back then because everything changed in the market, which has obviously affected valuations and IPO decisions. Then we have balancing public investors and the private board. Sometimes board members have different priorities and objectives. So while some might want a liquidity event, others prefer staying private. But for public investors, they need to see a united management team with aligned goals. Unfortunately, some factors like industry competitiveness and VIX levels are behind our control, but focusing on corporate readiness can make all the difference when it comes to timing an IPO. So how do you know when IPO window is wide open and when it's safer to wait? Well, understanding the market conditions and your company's situation can be the key. You see, if you urgently need funds, then you might have no choice, right? But to go public and face the risk. And that's why preparing early is crucial, right? When the window opens, your company can jump right in if you're prepared. And by setting up financial reporting processes and corporate governance policies, your business can act quickly when the opportunity arises. So the key is to communicate constantly with the executives in the team and board members, of course, and agree on targets that need to be met before going public. This may include consistent growth numbers, high cash flow, and compliance with regulations, because it's essential for the company's leaders to be on the same page about what being prepared means. But don't forget, also, waiting too long has its risks as well, right? Because if your business is ready and the IPO market is stable, delaying might lead to future market timing issues. So ultimately, market timing should be a significant consideration for businesses. And while recording or predicting when an IPO market window opens or closes, it's difficult. It's difficult to predict it. Understanding the factors that signal it's opening, things like the VIX index, the business performance, the competition, all of those can really help companies in general avoid poor IPO timing. So the takeaway here, if I had to summarize it, is that you got to prepare early and seize the opportunity when the window opens to raise more capital, hopefully at a higher valuation. Next, let's dive deeper into the signs that a company is ready to go public. So although it's hard to pinpoint the perfect moment, especially with market volatility, there are some common traits that IPO-ready businesses share. So here are 6 signs that the company is ready to go public. And the way you want to do it is imagine your business is like a rocket, right? So ready to launch into the world of public companies. How do you know when it's right time to hit that, call it launch button, right? So let's talk about 3 signs that your company is ready to go public. First up, can your company accurately forecast its financial performance? You see, precise sales and expense predictions are crucial, especially when you're dealing with institutional investors, because failing to meet forecasts can harm your business value and future ability to raise capital. So you want to make sure that you develop as a business reliable forecast and budgeting processes while you're still a private company. This way, you'll get investor trust when the time comes. Next, you want to ask yourself, does your company have the right executive team in place? You might need to level up your team to successfully lead the business once it's public. So you want to ask yourself if you think you have, people with public company experience in your C-suite team. Are they the ones to push productivity and execution to new heights? You need to ask yourself and answer that question. So you want to plan your team structure, roles, and responsibility before diving into the IPO process. This might mean expanding your accounting, finance, and also investor relations team. The third sign you're ready for the big stage is if your business is, let's call it audit ready, and regularly closes its books on time. So it's important to consistently close your quarterly financial reports before going public. If you have this practice, when you have this practice, it just helps you prepare for public reporting. And it might reveal the need for additional stuff if needed in disclosure, internal controls, or financial planning. As a public company, you'll face regular accounting reviews. You need to prepare for it. So it's wise to conduct internal audits before the IPO, right? To make sure that you're actually ready for it. So this way, any potential issues can be identified and resolved in time. So there you have it. If your company can forecast its financial performance accurately, has the right executive team in place, and is audit ready, then you could say that you're well on your way to being IPO ready. But just remember, preparation is key here, right? To make that leap into the world of public companies with confidence. You just want to make sure that everything is prepared. Next, let's explore the 4th sign that your company is ready to go public, which is having realistic valuation expectations. And the reason I'm saying that it's important is because when you enter the public market, your value will be influenced by the price to earnings ratio of similar publicly traded companies. So market dynamics and peers will play a role in the valuation you can assume during the IPO. And remember, your success as a public company will determine your valuation in the long run. So that was the 4th one. The 5th sign is having a compelling reason for going public, right? So what's the story here? Why are you going public? What's the story you're sharing with the world about why you're taking this step? And of course, the obvious reasons include accessing capital, facilitating mergers and acquisitions, and rewarding employees with equity-based incentives, IPOs can also provide crucial funding for R&D, new technologies, capital investments, acquisitions, and ongoing operation. So going public, you gotta have the right story, right? Going public is a significant milestone in a company's journey. And being publicly traded is call it a testament to your commitment to compliance and governance requirements. Plus, it offers early investors liquidity and a chance to realize a return on their investment. So in summary, if your company has realistic valuation expectation and a convincing reason to go public, you're one step closer to being IPO ready. Just make sure to stay true to your story and communicate it effectively to your target audience. The sixth sign that you're ready for an IPO is having a clear strategic roadmap. The way to look at it is, think about it as the blueprint for your business investment story. The roadmap, overall, this roadmap should describe your company while outlining a straightforward strategy and operational plan to grow and deliver the returns that potential investors expect from a public company in your industry. So in a nutshell, your strategic roadmap will drive the investment case and showcase the leadership vision for the future when you go public. The IPO process may be long, but early planning can make a huge difference here if your business story is clear and supported by a solid strategic roadmap. So if you got a well-defined strategic roadmap that communicates your vision and growth plan, congratulations, you're one step closer to being ready for that exciting IPO journey. Just remember, you want to stay focused on your goals and you want to constantly continue refining your strategy as your business evolves. Next, let's talk about the actors, participants in the IPO process. So the formal IPO process kicks off about 6 months to a year before filing. Once the external audit is nearing completion, everyone involved in the company registration will gather to basically discuss the IPO scope, set a timetable, and organize responsibilities between everyone. After that, the team prepares the initial S1 form and files it with the SEC, usually a month or two after the initial meeting. The SEC will then respond with comments requesting modifications to the S1 filing. The company must address these comments and submit an amended version of the S1. And this back and forth will continue until all the SEC concerns are resolved. Various professionals assist with the IPO process, handling fiscal, legal, accounting, due diligence, subscription, and promotional activities. But the company itself plays a crucial role, providing basically all the relevant information and data needed. So let's dive a bit into the specific participants and their specific functions, right? Because knowing the key players and their roles will help you approach an IPO with confidence. First up is the stock issuer, which can be a private company or government. It's considered, call it a stock issuer, if it's registered the stock with the SEC, underwrites it, and retains the earning from its sale. Companies go public for several reasons, like we said, right? They want to grow, reputation, lower capital cost, employee compensation, providing investors with an exit, and most importantly, remember, raising funds to support the business. So, with that in mind, let's understand how to identify who's issuing stocks and securities, the ones you might want to invest in or distribute. So first off, the issuer, like we said, it's a legal entity that creates and sells securities to get the money to run their operation. Remember, it can be a corporation, investment trust, or even a state body. The key here is that whoever issues the stock gets a benefit from its sale, either directly or indirectly. So it's important to remember that. Now there's something called non-issuer transaction. That's why we wanted to repeat that, because that's when the company or a person selling a stock doesn't directly gain from the sale. Let me give you a couple of examples so it's simple. A public relations company organizing an IPO for XYZ company, or a securities solicitor helping XYZ company register its IPO. Sure, these folks get paid, but not from the stock sale itself. You see the difference? So they might get paid through a retainer or something else, and it's important to understand the difference and who is allowed what, right? With that being said, moving us to the next step, which is understanding the different type of stock. We have common and preferred. First off, we have common stock, because when you hold common stock, you usually get dividends and voting rights at shareholders meetings. You even get to choose the board of directors. Common stock is listed as shareholders' equity on a company's balance sheet. But with those different stock, there is a catch, because if the company goes bankrupt or defaults, common shareholders are the last to get paid in a liquidation event, and they might not get paid at all. So that's the risky part of investing in common stock, which lead me to different type of stock, which is the preferred stock is, well, preferred in a certain way or certain ways. For example, when it comes to collecting dividends or claiming income or assets, preferred stock gets priority. However, they usually don't have voting rights. So unlike common stock, preferred shareholders receive fixed dividend payments usually. And if a company goes under, if worst case scenario happens, they get paid before common shareholders, but after bondholders. So when you're picking a stock potentially as an investor, consider its value, income, and growth potential, right? And obviously based on whatever is important to you. All right, next step, let's dive in a bit more on the investment banker. So these guys, remember, are involved in the financial activities like the security offers, like the mergers, like an acquisition, like the IPOs. But in an IPO, one of the key roles investment bankers play is the underwriting process, which we didn't talk enough about. When a company hires an investment bank, the bank becomes the underwriter for the company's IPO. They determine the company's value, they buy shares at a discount, which then later sell to the stock market. Sometimes, if an IPO is big enough, several investment banks might work together, like we mentioned before. Remember the syndicate? And the question is, how do we pick the right one? Because they're going to be crucial for us to the roadshow, because they'll introduce us to a lot of the potential capital that we want to raise. So imagine, remember the roadshow? It's like a big meet and greet thing. Bankers help set it up for companies to meet potential investors, and they aim to spark interest in the IPO. That way, they want to fill the demand. Remember, we mentioned that. Now, on the day of the IPO, bankers sell shares to the public, but they also put the lockup period in place, usually lasting 6 months, like we said. During this time, early IPO investors cannot sell their shares. This helps create demand for the stock, right? Remember those things. And pricing, of course, is crucial, because if a stock is overpriced, investors might walk away. But if it's underpriced, people miss out on a potential profit. And that's where the bankers, remember, are so important. They help companies set the right price and obviously bring capital. So how do you pick that investment banker? Well, all those companies, they come in all different shape and sizes. And same with the investment banks. Some are big, some are small, some specialize in specific industries, some specialize in specific locations. And here are some of the things you might want to consider when picking an investment bank for your IPO, right? So first of all is the market awareness. You want to find a bank that understands your industry and the market. You want to consider the goals and business maturity. So choose a bank that aligns with your objectives and where your company is in its growth journey. Then you want to consider interest level, experience, sales capability, market making ability, industry knowledge, and research and analysis. And let's dive into a bit of those a bit more. So starting with interest level, you want bankers who are genuinely excited about your business, right? They should give your IPO lots of attention and stick around for the long haul and not just be short-term thinkers. Then experience. You want to choose a bank that's, an IPO pro, especially with companies similar to yours. They'll help structure your offer to achieve the best financial goals for you. So you want to make sure that they work with similar companies. Sales capability. The bank's skill in selling your stock super matters, right? It affects your IPO early success. So you want to make sure that they're great at it and can put together a team to help all of this. Then let's look at the market making ability. So your investment bank should be a market maker in your stock and for your stock to ensure a stable market for it. We also want to look for industry knowledge. So if there's a bank that knows your market inside out, it can better represent your business and boost your IPO chances. Next is research and analysis. So find a bank with top-notch research skills. Their expert analysts will create reports about your business, raising investor awareness and attracting potential partners. Now, what do you think is the most critical factor when selecting an investment banker? Because everyone is looking at all of those points that we went through and valuing one of them more than the other. And at the end of the day, ideally you want to check a bit of both. Now, let's talk about investors and IPOs and kind of like what's involved there. People like you and me, the retail investors who want to invest in the next big thing, the next company, because IPOs can be a great opportunity for investors to get in on quality businesses early. It's a win-win for both the company and investors. So with IPOs, there are different categories for investors. There's, call it specific, also quota of shares allocated for each category. So let's go through that. Companies prefer to work with large institutional investors like insurance firms, mutual funds, and pension funds because it's easier for them to reach their capital goals when they raise capital in the IPO with just fewer big players. Right? Makes sense. But what about the little guy, like us, the normal everyday that isn't owning an institution? Well, there is a good news because today we can also invest in companies just starting out, often for just few bucks, but we need to be ready for the risks that comes with it. IPOs have always attracted interest, especially with all the buzz surrounding them. So it's hard to ignore the excitement and potential of getting in on the ground floor in a company. But for a long time, average investors were just spectators. They just, they had to wait for shares to start trading if they wanted to join the IPO about to go public. Luckily, things have changed. So now we can all be part of a lot of exciting IPOs. So it's just a matter of finding them and understanding where to look for them. So sometimes it depends on the deal. Brokers approach the little guy to invest in IPOs. And even though it might raise some eyebrows, call it, things have very much changed over the last few years. So some companies let investors put even as little $100 into an IPO. Again, depends on the business. And the more small investors they have, the less uncertainty and fear they face about, let's say, call it a major investor selling all of their shares. Next up, let's talk for a second about qualified investors. Those are, call it mutual funds, public financial institutions, international portfolio investors, and commercial banks. They need to be registered with the SEC, and underwriters usually sell them IPO shares at an attractive price to come in early. They also sign a lockup agreement usually for 180 days, ensuring that they won't sell their shares immediately after investing in the business. So having qualified investors on board with IPO can really boost the IPO success, as it might lead to a higher share price due to limited availability for the general public. Lastly, there's the accredited investor. Those are individuals or corporations that meet specific criteria regarding a professional experience. Also depends on their income, the asset side, or their net worth. These folks are considered financially savvy and don't need as much protection as non-accredited investors. So now that you know a bit about the different type of investors, first of all, ask yourself which one and which category are you. Next, let's talk about the two levels of securities markets, the primary and secondary, right? And to understand it, let's start with the OTC markets, short for over-the-counter. This is where securities are exchanged between dealers via computer or phone, rather than on an organized exchange floor with the bigger ones. OTC stocks are usually from smaller companies, and the most famous OTC securities market is Nasdaq. Before diving into an IPO, proper due diligence, of course, is critical. And that will help us understand the next point, which is due diligence. So let's talk about due diligence, especially when you're thinking, of course, of going public with a company or your company. You see, due diligence is super important because it helps you understand and tackle the risks of listing your business on stock exchange. It's carried out by IPO lawyers and underwriters. So knowing the process can just save you time and effort when the IPO officially begins. So what's the deal with, let's say, before you go public, what's the pre-IPO due diligence process? So it's, first of all, what's the deal with it? It's kind of like a checkup to see how mature your business is. So all your advisors, they'll review every aspect from finances to legal matters and even IT. And the goal here is to evaluate your business model, planning, potential, and spot any risks or opportunities. And remember, all the data in the prospectus is based on due diligence. So any misleading info could mean trouble for the company and the banks promoting their offer. So who's involved in the IPO due diligence? Well, of course, there are bankers and there are also other key players like attorneys. And all of those are there to make sure that everything is legally compliant. Your IPO team will also work closely with financial printers and accountants that we mentioned. And they play a critical role in the IPO to make it successful. At the end of the day, due diligence is all about credibility, both for the company and the investors. And it just increases the chances of a successful IPO. So it's definitely worth the effort, and it's definitely worth the cost. So let's break the due diligence process down. During that process, underwriters and lawyers will work on the registration statement, and the company has to validate pretty much all the info in it. If you claim something about a certain technology, you better have evidence to back it up that the SEC will approve. Key employees will be involved in discussing pretty much everything from marketing strategies to sales forecast to product roadmaps. Even third parties like clients and vendors might be interviewed in this process. Who does that? Well, it varies depending on the market, the sector, and risk profile of the business. But here are some key tasks that are involved. So first of all, lawyers prepare due diligence request list for the company. The company's auditors will then provide a comfort letter with guarantees about the financials. The CFO might step in to help with any additional needs. and the company is then responsible for producing all required materials. Underwriters or lawyers will then interview management, auditors, and possibly other third parties. The most time-consuming part for the company is usually gathering all materials needed to respond to the due diligence request list. To save time and money, it's best to know what's needed beforehand, and that's what we'll go through and we'll now expand on next. So if you're curious about the checklist, right, let me give you a breakdown of the tasks involved in the IPO based on the info needed in the prospectus. So the checklist for the due diligence, here are some of the things you'll need, right? So copies of articles of incorporation and info on business partners, copies of proposals from business directors and the governing board, list of committed and shareholders, summary of shares held by each shareholder, state secretary certificate of good standing, report on operational decisions and agreements, annual business reports for the previous 3 years, list of states where the company is authorized to do business, summary of corporate strategies and strategic plans, illustration of the organizational structure, including documentation of all employees, directors, and board members. Next is license and tax items, right? We're talking about copies of operational and business licenses issued by the state secretary, report on the details of the company's tax agreement, list of international, federal, and state taxation info for the previous 3 years, summary of tax-related info for the last 5 fiscal years, summary of government licenses and permits, copies of the last 3 years income tax records, summary of the last 3 years employment tax filing. So these are some of the key items that you'll need for IPO due diligence checklist. Now remember, being prepared with all this information can just save you a lot of time and effort during the process. Remember, you'll need to gather all these items alongside your team and make sure you're prepared to move forward. Next, let's move on to discuss the company employees and board information that you'll need. So we're talking about copies of employment lists, including board directors, executives, and employees, details about each employee's status, roles, and salary, details on employee benefits and privileges for each position, summary of policies regarding sick leave and employee problem solving, summary of health insurances and other insurances provided to employees, resumes of the company's key employees, copies of employee audits for the previous 3 years. Next, let's discuss the financial items for the checklist. So we're talking about copies that you'll need of previous arrangements with investment bankers and brokers, copies of financial statements for the previous 5 fiscal years, summary of financial audits and documentation from the previous 3 years, list of all company state and foreign business financial accounts, copies of financial analyst reports for the previous 3 years, illustration of the inventory and access authorization, illustration of the company's contingent liabilities and financial strategies, and details about accounting practices and amortization methods for the previous 3 years. Also details on fixed and variable expenditures for the last fiscal year. Gathering all this information is crucial for smooth IPO due diligence process. Next is customer and property items in the due diligence list. So if you wonder what those might be, well, the customer items, we need, first of all, a report with all the details on your business products and services. You also need legal endorsements, information on your top customers and your marketing strategies and plans. Plus, don't forget copies of customer supply or service agreement. Now, when it comes to property items, we'll need a list of business locations, licenses, real estate agreements, and an inventory of your company's assets. You'll also need to see and show your trademarks, copyrights, patents, and any records of disputes or issues related to them. And of course, copies of contracts for purchasing real estate. Now, I know that's a lot of stuff, right? But remember, going through all of these items is just crucial for a successful IPO due diligence. Next, let's talk about the syndication in the IPO world and expand a bit more about that. So imagine you're a company with a massive transaction to manage, too big to handle alone. That's where syndicates come in, right? These temporary, call it partnerships, lets companies pool their resources and share risks. And in the case of IPOs, we're talking about a group of investment banks working together to bring new securities to the market. Now, focusing on underwriting syndicates, their job is to underwrite the IPO, sharing the responsibility and helping to issue this new security. And when an issue is too large for one company, an underwriting syndicate is created, like we said before, right? Now let's do a bit of a deep dive because it's a allowing all the participants to manage the issue and distribute the risk. Now, how do they get paid? Through the underwriting spread, which is the difference between the cost to the issuer and the price earned from shareholders and other broker-dealer when the issue is publicly released. You might hear an underwriting syndicate referred to as an underwriting group, a banking syndicate, or an investment banking syndicate. Instead of a company selling shares directly to buyers, members of an underwriting syndicate can purchase shares from the company and sell them to investors based on the offering. And the beauty here is it eliminates a major risk for the issuing company because the syndicate pays for the stock in advance. They take on the responsibility of selling the shares to buyers, and by sharing the risk among all group members, the lead underwriter risk is minimized. Now, of course, if the market isn't strong as hoped, then the syndicate members may have to keep part of the issue, which basically means risking a price decline. The lead underwriter earns a larger percentage of the underwriting spread and under other compensation, while the other members get a smaller share. Next, let's dive into the process of determining the IPO price. The syndicate members meet and agree on the initial price together. They distribute a portion of the shares before the IPO hits the market. Once it's out there, the price go up or down, affecting the members' profits. Finally, they sign an agreement outlining the stock allocation and responsibility for each party. But I don't know if you know, but there are different types of underwriting in an IPO. And let's explore those a bit next, right? And with underwriters, why do we need underwriters? Remember, think about them as the bridge between your business and investors. They'll discuss how much money you want to raise, the types of shares to sell, and pretty much hash out all the details of the underwriting agreement. Now, this agreement can come in different flavors. One option is, call it firm commitment, where underwriter guarantees to raise a specific amount by buying the entire offer and reselling it. We mentioned it a bit before, but now it's a bit more of a deep dive. On the other hand, there's also the best effort deal, means the underwriter sells shares but doesn't promise any exact amount raised. And here's the catch here: bankers, they don't want all the risk, right, on their shoulders. That's why they often use those syndications that we mentioned before. That's how they spread the risk and making sure that whatever agreement they have is being handled in advance. All right, now let's dive into the world of the stock market and understand where the buying and selling of stocks happens every day and how it really works. But first, let's make sure we understand the basic. You see, a stock market is like a giant marketplace where shares of publicly traded companies are bought and sold. It follows very specific set of rules, and these transactions happen on exchanges like we mentioned, like the New York Stock Exchange, the NYSE, the Nasdaq, or even the Chicago Board Option Exchange, the CBOE in the US. And it's not just stocks, right? Because other financial instruments like ETFs, corporate bonds, and even currencies are traded there. So how does it all work? Well, the stock market creates a stable and controlled environment for low-risk transactions. So it's kind of like a safety net that ensures everything runs smoothly and fairly. And when a company wants to go public through an IPO, the stock market provides the perfect platform for their shares to be traded. But how investors are then interacting with the stock market? And let's understand the different participants involved, right? So imagine you're an investor who buys a company stock. You hope that the price will go up, so you receive dividend payment or the overall stock value is up. The stock market, like we said, is the place that enables this, right? So they earn commission for its services. Their main responsibility is maintaining transparency, fair trade, price discovery, and liquidity. And they make sure that both sellers and buyers get fair prices. Now, maybe you also heard about indexes like the S&P 100 or Nasdaq 100, or S&P 500, which is more famous one, which are created by stock exchanges, right? They also maintain all the news, updates, financial reports, everything related to businesses that are listed. And you can find all of those on the websites. Now, to understand that, we need to dive into the different participants in the stock market, right? Each serving their own unique function to keep the market running smoothly. First, we have the stockbrokers. These are the registered professionals that buy and sell shares on behalf of investors. So they act as a middleman between the stock market and the shareholder. So if you want to access the markets, you'll need an account with a retail broker that you might have already accounts with. Next up are portfolio managers. These professionals manage portfolio of securities for clients, right? They rely on analyst feedback and they make buying or selling decisions. Portfolio managers, they work for mutual funds, hedge funds a lot of times, and retirement plan providers. They make decisions and call it setting investment strategies for their capital. And lastly, let's talk about investment bankers. We talked about them a lot. We've mentioned them quite a lot, but they understand they help businesses in different ways, right? They take companies public, they manage the listing processes, they also keep the stock market regulatory requirement in hand, so that's kind of like their responsibility. Next, you want to understand a bit more about key players in the stock market. So we've got custodians who safely keep client securities to prevent theft or loss. We got market makers, on the other hand. There are broker-dealers that make trading shares easier by maintaining an inventory of securities and providing bid and asking prices. And we mentioned also that there are a few stock markets, right? In the US and other countries, stocks can be traded on exchanges or over the counter, so OTC. OTC trading is for companies that don't meet the criteria usually from major exchanges like the NYSE or NASDAQ. OTC markets, they serve, call it, kind of like as a hub for these smaller companies before they're ready and big enough, allowing transaction to take place in listing facilities, so sometimes known as pink sheets companies. Or maybe you heard about the OTCBB, over-the-counter bulletin board. That's an electronic quotation and trading service that offers greater liquidity and better information sharing. So it's for stocks that can't be listed on formal exchanges. These unlisted stocks are typically from those smaller companies that are not known yet. They can't meet their listing requirements, because to trade in the OTC securities, broker-dealer use the OTCBB, making it easier for investors to buy and sell shares. Pretty much any size companies can go there. And I don't know if you know that, OTC are also maybe known as unlisted stocks, right? So while those exchanges are referred to as listed stock, it's an interesting world that there is in the stock market for companies that think they can raise a bit of money, and then over time as they grow, go to the bigger ones. And to trade there, it's very similar. You need an account with an online broker, and they handle all the OTC stocks just like a regular stock. Then, to do that, you just go out there, you find the ticker symbol of the company you're interested in, and you just make sure you got enough funds in your account and you buy the stock. That's it. And remember, with all of those markets, companies don't buy and sell their shares daily. They might do stock buybacks or issue new securities, but not as kind of like an everyday transaction. So when you buy a share, you're not getting it directly from the company. You're actually buying it from another shareholder. And when you sell, you're passing it on to another investor. And therefore, there's what we call kind of like an auction mechanism where buyers and sellers place bids and offers. A bid is the price someone's willing to pay, while the offer or ask is the price someone wants to sell. And when bids and ask match, then a trade happens. So in a nutshell, a stock exchange is a platform that matches buyers and sellers of stock and kind of like to allow to easily and conveniently buy and sell shares. So as we get close to end this, remember, getting a company listed on a stock exchange isn't a walk in the park. There's so much happening behind the scenes before you even hear about an investment opportunity, right? Imagine this, like a company need to hire a whole team, right? We talked about them, a broker, accountant, auditor, underwriter, legal expert. They have to prepare audited accounts, submit applications, and tidy up all the business before even presenting it to investors. But the beauty is that as the time goes by, you might even hear rumors that a company preparing for an IPO, right? Then there's kind of like the final official intention to float. They announce it to the public, which can be sometimes days or weeks before the listing date. That's an opportunity for you as an investor to learn about the company, how much they want to raise, and when they plan to go public. That's when you as an investor can start to check in out on the business and decide if and when you want to invest in. Then there's the broker. They step in, they make sure that their company raises enough funds to float and operate. Sometimes they take more orders for stocks than available shares, leading to what we call an oversubscribed offer. In such case, the broker decides how many shares each investor gets. And once the shares are allotted, the stock hit the market and trading begins. And remember that usually when a retail investor comes in, like there's a lot of institutional larger investors invested earlier, and they have usually a lockup period during which they can trade their shares. But in the end of the day, like any investor, their goal when investing in an IPO in a company, they have two main goals. They want to get the bump and the hype, right? So the IPO bump refers to basically the idea of getting an immediate increase in share price that often happens after a stock is listed. That's why there's an interest for an investor to invest earlier, right? So for example, in 2016, biopharmaceutical companies saw an average bump of 141% in the day of being a public company, which is quite a return if you catch it up. But remember, not all the companies get that boost. Then there's the hype. The media loves covering exciting IPOs, and rumors can positively impact the share price. But of course, this isn't always the case either. And when it comes to investors, not all investors allow retail investors right away to invest. And it's really up to the dealers and the company whether they allow retail investors or not. right? And opening it up to retail investors might just means more paperwork and effort and different registrations on their end. So look, we covered a lot today. We could probably talk about it for a few more hours, but we covered IPOs, disclosure requirements. We talked about NYSE and NASDAQ listing rules and IPO costs and who are the participants and the due diligence and syndications and underwriting, and a bit about everything related to the IPO process and the stock market operations as well. I really hope this info helped kind of like clear things up. If you enjoy this, then please let me know your thoughts in the comments below. I'd love to hear from you. And if you have any ideas for other videos just like this, when you want me to do deep dive, let me know. Hope you enjoyed it, and I'll see you soon.